Morning, buddy. Morning, Dan. Morning, everyone. How's it going?
Yeah, really good. Really good. I woke up this morning breathing, so it's a great day.
Awesome. I got out of bed about 20 minutes ago, so it's been a nice lie-in. So.
Are you still in your gym jams, mate?
I am actually, yeah.
Good man.
Always. I mean,
Enjoy your clubhouse, eh?
who gets dressed for work these days? I mean, honestly. That's so 21st century.
There you go. I love it. I'm a bluff old traditionalist. I'm still in the office in London. I quite enjoy being in an office, to be fair.
Ah, fair enough.
You're
Yeah.
London guy.
Yeah.
Blimey. Even though you live...
indeed.
Wait, even though your office is way up north?
So we have a main office about 3 miles from where I live, because, well, like you, I like to kind of roll out of bed, walk to the office, all that kind of stuff.
Yeah.
So that's fun. Or cycle or ride or whatever. But in terms of the London office, obviously during lockdown it's all been a bit weird, really.
Yeah.
But on the other hand, it's been quite a nice time to come here when it has been quiet and get really, really focused time as well. But once things start to open up again, I'll be spending time with funders and finance people and city lawyers and all that malarkey as we build the fund, really. So
Cool.
yeah, it'll be interesting as that develops.
Awesome. Just a quick one. I have to leave at
Jeffrey
11:50.
Stage.
Oops.
Okay.
So I'll just quietly slip
That's
away.
all right. So we've got our gang piling in. Morning, Jeff. Good to see you.
Well, morning. I'm pleased to be here.
How are you?
Yeah, no, really good, really good. I hope I didn't bore you too much last night, but
No, far from it. Just for the benefit of the audience, and we will come back to Jeff on this. He did an excellent presentation last night on his interpretation of the budget, which I'm sure will crop in questions today. So it's going to be very interesting. But I think what we'll do, the room's filling up, which is brilliant. So welcome everybody this morning. What we tend to find is this kind of fills up bit by bit as we go along. So Andy's here as well. Morning, Andy. How are you doing?
Morning, Guy. I'm good. Another week older. Can't believe how fast it goes.
It whizzes by, doesn't it? Absolutely whizzes by. So but good to see you this morning. So,
Thank you, mate.
So I think we've got most of the panel here. Gavin's not around, and I'm not sure if Phil's tied up on a call. So what I'd like to do this morning is just kick off with a brief kind of 1 minute elevator brief as to who you are and what you do. So Dan, do you want to shoot?
Oh, sorry.
Dan,
Yeah, I'm
you there?
Dan Taylor. Yes, hello there. Hello, everyone. I'm Dan Taylor, the one in the middle at the top with the orange circle around him, with a bow tie. It was a great evening that evening. And what I do is I love to create cash flow and capital chunks via acquisitions of businesses and commercial property. Really focusing on the commercial property end to retain with hopefully zero leverage or very little leverage. And why? Well, it's simply the fastest route to create cash flow and capital chunks and generational wealth. And one other thing, and we love to share the profits with our investors. Nothing better I love than paying people money. So that's me.
That's good. Brilliant. Thanks, Dan. Siam?
Hey there. Yep. So I'm probably the least sophisticated person in this panel. I'm just a simple boy from Norwich.
I would not say that 1 second.
No.
But anyway, go on, mate.
But yeah, I just
Mr. Crypto. I think you say that, Mr. Crypto.
yeah. I just buy. I've bought dozens of businesses over time. I've got a small group of about 9 companies, and I just struggle to run all of them. And that's it. I treat life like a video game. So my mantra is: do, fail, learn, pivot, and try to do that as fast as humanly possible. So I just like making mistakes and then moving on. So I just got lots of errors under my belt. That's all.
And those are some of the best things, Sam, without a shadow of a doubt. I try very hard to share all my fuck-ups with the audience and with anyone that I engage with, because I'd rather do that and be open and honest about the things that we get wrong, because people learn from that far more than they do from, guru successes. It's all a bit of nonsense, really. So Yeah, very open to that.
That's a great point, Guy. We should do a session next week on failing forward and the biggest lesson that you gain from it, and then what you do now as a result of it. You know,
we won't have enough time.
No, we've only got an hour and a half. That's never going to work.
A series, trilogy.
Absolutely. Liz Ward, welcome to the panel. First time in this room on the panel. So great to have you here.
Thank you, Guy. Do you want me to tell everybody a little bit about what I do?
Give us your quick 60-second summary.
My elevator pitch, right? I run a law firm called Virtuoso Legal, and we specialise in dealing with intangible assets. So we help people sort of create and look after innovation, everything from brands and software through to databases and patented type technology. And we help them not just protect it, but we help them commercialise it, not just in the UK, but globally. So I'm very much in the clicks, not bricks arena today.
That's brilliant. Thanks, Liz. And for those of you who don't know Liz, she's wonderfully forthright, hugely experienced, and I believe IP is a massively overlooked area of any business, particularly for enhancing the quality of the balance sheet. Just as a general rule for everybody in the room, make sure you connect with the panel. There's a huge wealth of experience and knowledge here that everyone would benefit from. So check us out on our social media links, Instagram, etc. And I know for a fact everybody here is keen to help and add value and advice where possible. And talking of balance sheets, we've got the maestro of balance sheets, Mr. Jeff Lerma. Tell us about yourself, Jeff.
Hi there. Well, I'm a chartered accountant. I run a practice in North London. We specialise, I suppose, in really sort of inventive and lateral tax structures to sort of help people get the most out of their business. And we're doing a lot of buy-side acquisition work at the moment, which is really good because there are so many ways of doing that, and it's and what's potentially unusual for a chartered accountant is actually I do it myself as well. So I don't just we don't just talk about it; we actually do it. So which I think possibly see the difference between this assertive accountant and not assertive accountant is whose shoes does he look at when he talks to you. But hopefully I'm going to be looking at your shoes, not mine. So yeah, it's getting that sort of structure right and helping people achieve what they want to achieve.
Yeah, brilliant. Thanks, Jeff. And welcome, Kim, as well. Great to have you on the panel for the first time. Tell us a bit about yourself.
Morning, Guy. Hopefully you can hear me. I'm out and about on a walk. Oh, fantastic. So like Liz, I'm a lawyer, but I specialise in corporate M&A. So for years, worked in private practice at large international law firms, acting on multi-million pounds worth of M&A deals. The last couple of years, I switched to go in-house. So I now advise on a contractor basis. I go in, advise on transactions or commercial contracts generally. Also a property investor, so invest in blocks of flats and HMOs generally in the Midlands, Northamptonshire and Buckinghamshire. And I'm looking to acquire my first business this year that will complement my property investment business. It's great to be on such a experienced panel.
Well, it's good to have you here because the legal aspects of any deal are crucial, really. And when we chatted, it was obvious that you can add some real value to that. So great to have you here. Morning, Andy, all the way from sunny Spain.
Morning, Guy. Can you hear me now? Only one earbud has run out of battery.
I hear you loud and clear.
Perfect.
Sound like you're in the toilet, but apart from that, we can hear you loud and clear.
Do you know what? I've just made a load of sales in the last week. I need to go to buy some proper Apple earbuds instead of some unbranded ones. It's great to be here because it's such a small world. I've just seen Paul Abrams. I think you were trying to wave to me or comment, and I haven't sussed out Clubhouse properly because this is the only meeting I come to. I worked with Paul when we were both business coaches, and he still is, in 2003. So I've coached business owners to grow and sell businesses as well as buy. But in the last 10 years, I've niched into LinkedIn because so much of business is about marketing and sales, and that's really my passion and background, niche. And I have two things that are very unique, and most people will have a love-hate relationship with LinkedIn. They are what they are. I have some automation that allows me to go and connect and engage with your growing number of connections and new prospects every day and generate inbound leads. And Guy knows this, he uses it. I get a lot of my clients paying me to do it for them. And then we've also pioneered a route to be able to get thousands of views of your posts, but at the same time teaching people how to write content that works. Because I think what we've seen now with COVID is the world is being bombarded by connection invites and happy marketing messages, sales messages, content. And there's a more important need than ever to understand how to write content that engages with your ideal prospect. But the great thing is more people are active on it. So I'm working with guys like you who are looking to engage with business owners to talk to them about buying their businesses. So anything I can help in and around LinkedIn. We have something that is genuinely unique, and I get passionate about it because people out there go, well, it's too good to be true. So if you're looking at generating more business through your LinkedIn stuff, I'm sort of happy to talk. And I'm happy to hear I'm looking forward to hearing where Paul's at. It's been a long time, mate. So it's good and it's good to see Kim online because she took over running the Property Investors Network at Birmingham NEC that Mary and I have been running for a couple of years. So what a family we have here on Clubhouse today.
Absolutely, Andy. Absolutely, and lead gen in any business, but especially in looking to acquire companies is crucial. So anyone thinking about that, definitely connect with Andy. And as you said, this stuff is a bit unique and pretty impressive. So thanks, Andy. And I'm really delighted to bring Paul Evans onto the panel today. Paul and I have known each other for a while now, and it's fair to say he's got an incredible track record in helping business owners to scale and grow their businesses. But the angle that always attracts me is with an eye to exiting, and that's the thing that's so often overlooked, really. So welcome, Paul. It's great to have you here.
Yeah, thanks for having me. Great to be here. And it's for the last 17 years, really, I've been helping what I like to call kind of passionate, positive entrepreneurs to create shareholder value, scale their business to 7 or 8 figures and exit for fairly life-changing sums of money, or what we call a capital event. So I run 3 businesses. Right now I run 2 incredibly successful masterminds in the UK, which Guy, you came and spoke at in January. As a result of that, one of my masterminds last year bought 8 businesses successfully. They've already bought 2 in the first 2 months of this year, which is fantastic, and we have big plans for that group as well in terms of what they're going to achieve this year. But I'm passionate about a couple of things. We use Andy's tool for LinkedIn, but I have a digital marketing agency that we started 2 years ago that helps people build online sales funnels that create elegant, high-converting customer journeys. If you're going to buy a business, you want to make sure that you can scale the customer acquisition piece, and funnels, in my experience, are the best way to do that. And that business has gone from startup to just on track to do $1 million this year, with a team of 20 that now are in that business, which is super exciting, and we've got great plans for that over the next 24 months. As well as really, I'm passionate about teams and team building, and I bought a profiling company just over 12 months ago. Bought that. We're in 19 countries around the world now. With that, and one of the things I've learned about selling businesses or helping clients sell businesses and buy businesses is that the team is a critical element in that. If you have the right people in the business, it's easier to sell. If you buy the business and don't understand the people you have in there, then it's going to be a lot harder to grow it. So we specialize in helping people understand and build high-performing teams. So for me, the P in my name stands for performance, team performance, business performance, profit performance, and A is all about taking action and having accountability, because without action and accountability, nothing gets done. So thanks for having me on, Guy. Really excited to be here today.
It's a pleasure.
Andy, by the way, if you flick your mic, it means you're essentially clapping at what the speaker's saying, just so you know.
That's good. And last but definitely not least, Mr. Jepson. Good morning, Phil. How are you doing?
Yeah, good, thank you. I'm feeling particularly humble this morning.
Why is that?
In the company of all these incredible human beings who are doing all kinds of stuff, and all I'm doing is buying engineering businesses. I feel very humble.
Oh well, I would emphasise that what Paul's just talked about is that sort of action taking. You can fill your head with knowledge, but ultimately you've got to take action. As one of my clients that I'm very proud of through the Business Buyers Club, you're an exemplar. You filled your head with the knowledge, took action, and you're at it, and that's brilliant. life-changing stuff. So tell us a bit more about yourself, Phil, for the benefit of the audience.
Okay, well, I'm a lawyer as well by trade. I spent the last 15 years as a lawyer, and then got out of that, got into business, and I've spent the last 20 years owning, running, managing, leading businesses. And about 2 years ago, thank you to you, I discovered that it's possible to go out and buy businesses. And so I decided that's what I was going to do, set out on the journey, and I'm now making it happen and building a portfolio of businesses focused all around engineering.
Yeah, no, it's brilliant. Well done. So the way that I like to run the room, as the title says, it's a live Q&A, which means we don't know what questions are going to come from the audience or the people in the room, whatever the correct description is. And that keeps us on our toes, and we love it. But we thought from the growth of the room, what we would do is sort of start each session with a starter for 10, if you like. So today's topic is a bit of a hybrid. So it's deal structures, but what hangs off that is also funding and funders. So I'm going to kick it off by talking about a little bit about the key finance structures. Siam will tell us a little bit, I'm sure, about some of his really clever no cash requirement deals. But in my world, I tend to focus on deals that are going to need some cash in them. So fairly sizable businesses, multi-million turnover companies with management teams and so on. And the way that we target those in real simple terms is we look at the balance sheet of the business, and we look at the assets on the balance sheet, and they provide one of two routes really to funding. One is to do what's called asset-backed lending. So you're leveraging the value in the balance sheet. For example, the debtor book, there's unpaid cash tied up in a debtor book. That's basically productive work that's been completed. It's just not yet come into the business. You've got things like tangible assets, that could be machinery, equipment, etc. A bit like mortgaging a property, create cash flow from that, and so on. Or you're also looking at loads of cash that amazingly sometimes is sat on the balance sheet. The number of businesses that I look at where they treat money as a kind of piggy bank in their company. And always the vendor wants to see that cash come back in the deal, which is fine, because although it belongs to the company, it's their company, so it's kind of their cash really. So that's one of the start points. And then from a P&L perspective, we always look at what's the quality of the business in terms of its profitability, its reliability in terms of consistent performance, cash flow generation, etc., and margin. How much net cash is the business generating that can also go into the deal? That's basically how we look at structuring deals. So they're not without debt, they're not without good debt going into the business, but they are structured around the historic performance and future contracts, quality of client base, and so on. Those are kind of the key principles, really. And for that, there are lots and lots of funders in the UK, and I never go to the major banks. People like Barclays, Lloyds, etc., are absolutely not interested in, well, the SME market, and definitely not in management buy-ins, as they're called, MBIs, or to some degree MBOs even. It's just not a sector that they're interested in. So we deal with a plethora of second-tier and challenger banks. So companies like Aldermore, who are quite well known in property, for example, but they also get involved in asset lending, and they're very active in the M&A space. And there's a whole list of companies like that we deal with. Then they get their funds from a mixture of places. Some get their funds directly from the high street banks, kind of like back-to-back lending. Others raise cash from investors, investor platforms. So people taking bonds, 5-year bonds and so on, and that money is recycled into deals. So it's quite a broad sector. Cash flow lenders, as we call them, are people that provide term loans into deals. So you can either do asset lending or you can do term lending. And term lending is a more restricted market, and they tend to be able to cherry pick the ones that they like the most. And every lender has what's called a sector appetite. So a given lender will have a percentage of their available cash that they will make available for a particular sector. And when they've lent to that sector, they're full. At the point where they're full, it doesn't mean your deal isn't any good. It just means that they're maxed out. and until they get money back in, they're not able to lend to that sector. So sometimes it's a question of timing, sometimes it's a question of appetite. But that's a really fast, rapid skim through the framework, if you like, for funding in the UK. And it's broadly the same in the States, although there are a lot more funders over there because it's a massive country. So I just wanted to give that kind of heads up, really. In terms of the deal structures, they tend to echo what you see on the balance sheet and the P&L of the target company as to what you want to go for and what your start point is, really. Jeff, is it worth just bringing you in at this point just to see if there's anything I've missed of obvious note for the benefit of the audience?
No, I think it goes exactly that. When you're looking at an acquisition, you really want to see what you can squeeze and off the balance sheet as much as possible. And there's just so many different things available. One, you've mentioned it really, but it's just obviously the rates are really important as well. Personal guarantees are really important. Insurances against personal guarantees, all that sort of stuff to make that transaction work. But what it is, it's just being lateral. Because people don't see the value of their business. It's literally, from what Elizabeth said, there are so many assets on people's balance sheets that are just not disclosed and not shown, and just get as much out of that as possible. So, but it's being really flexible. I think obviously things are going to change a lot from 31st of March, and the civil's change, but that's going to be a little bit more. I think that stage funds have never been so available. And it's going to change a little bit, but it's just what it is, isn't it?
Is that when the magic money tree dies?
I think it is. I think that money tree's been, whatever. I've been in accounting since 1985. Bloody hell, it's a long time. But I've never seen money so available. Just never. And it's been absolutely amazing. So. The replacement is not massively different from what there was before, and banks have a lovely idea of just saying no if it doesn't suit them, and who knows? They may be more open to it. They may have got, if you get someone to say yes 4 times in a row, they may carry on saying yes. So you never know; it might be possible. But I think it's going to be a lot tougher going forward, especially on the sort of small company purchase side of things. I think it's going to be massively challenging, and just need to be more inventive.
Yeah. No, thanks, Jeff. Dan, anything you want to add to my opening ramble?
I think it was a great summation, to be honest, and some background from Jeff, and I think it'd be great to answer specific questions we have from the wonderful group we have here, because everyone's coming from a different standpoint. They're doing different deals, and therefore the requirement for finance for individual deals, sectors, types of deals is all different, and it's a wonderful creative space. And I love buying businesses that own their own commercial property, relocating the business, and then using alternative use for the business, and that requires a different kind of finance than your LBO, a different kind of finance in Siam, in for a $5 and a free sandwich, which I love. And I've done one of the, I've done a few of them before, but I'm more focused on businesses that are old school, in decline, that own their own commercial property, have done for decades. It's all depreciated. They don't understand commercial, so you've got 2 bites of the cherry. I see it as like 2 sides of the same coin kind of thing. You're buying 2 business while you buy 1 business, but you're only getting the valuation based on 1 business, and hidden beneath in the balance sheet is this animal that wants to be unleashed kind of thing, being the commercial property. So that's what I love, and a very different kind of obviously a very different kind of financing required for that than yours. So why don't we open up to questions, perhaps?
Yeah, absolutely. So Alex has put his hand up. So before we come to Alex, I just want to say the way we prefer to run the room is if you want to put your hand up, that lets us know that you're keen to ask a question and come to the panel. But if you do that, we'd appreciate it if you can try to make sure you connect with everybody on the panel as well. That way, if something crops up in the conversation, it's easier for us to come back to you separately outside of the room. So please do make sure that you click on the connects as much as possible. So without further ado, let's come to Alex. Morning, mate. How are you doing?
Good morning, folk. How are we all doing? Good to hear the stories on here as usual. I could have asked Dan this later on today, but I wanted to ask Dan, but also get an opinion from yourselves, the rest of the panel. Like Dan, I'm I'm interested in buying businesses with an underlying commercial property, but I'd like to just ask about funding of businesses. You've touched on it, Guy, but I was hoping maybe we could go into a bit more detail about how you would fund a business with a commercial property. Would it be kind of your traditional commercial mortgages that you would be looking at, commercial loans, or is it slightly different finance than that? And then if we just look at the MBIs, MBOs that you were talking about, Guy, maybe you could give some detail about, you mentioned Aldermore, but what's the max LTVs? Is there some tricks of the trade that we should be looking at? How do we structure that? Just have a little bit more technical detail if that's possible.
Yeah, I'll kick off quickly because the last bit of the question is fairly easy to answer. So the key thing when you're looking at any debt structure is to think about debt serviceability. Every lender wants to look at the business in the context of can it repay the money, essentially. So term lenders, and even to some extent asset-backed lenders, will be looking at the ability of the business, the predictability of that business to repay the debt, essentially. So what you want to be thinking about is ratios. So if you look at, for every pound borrowed, how much cash is the business going to generate, essentially? And if you're thinking about ratios of anywhere between 1.2 to 1.4 as a basic measure, essentially. And secondly, from your point of view, you want to make sure that you have got capacity, you've got headroom. So when I do a cash flow forecast, it's a really simple, the more I'm borrowing, if I'm borrowing 7 figures, I want to see 6 figures permanently sat in that bank balance. If I'm dipping below 6 figures in the bank balance, chances are I'm heading into risky territory. And actually just doing a graph on a spreadsheet is quite a useful indicator. So think about it in those terms. Rainy weather, times as well. Think about how much burn rate, overhead without income would you need to cover for a period of time. Now, I always used to talk about 6 months and people would laugh at me. Say, you're not going to go for 6 months without any revenue. Well, guess what? Last year, COVID hit, and we went for 12 months without revenue in some cases. So, the unthinkable can happen. So those simple guidelines is a really good start point. When you're thinking about the amount of debt that you need to put into a deal or into a business, it's always about debt serviceability. And that includes, obviously, the deferred consideration for a seller, making sure that you've got that covered at the same time. Because you never, in my world anyway, you never ever not want to pay deferred consideration. It's your reputation, it's the relationships, it's just de-stressing. You don't want to get into litigation, promise you. So those are the kind of key metrics, really, I would suggest. Does that help?
Yeah, would you then suggest then you would want 6 months runway as a minimum on your balance sheet when you purchase this in terms of cash?
It's a P&L thing rather than a balance sheet thing. So I kind of look at what net cash there is available at the point of completion, and just have that headroom, and your cash flow forecast will tell you that anyway. So I just think of it in those terms. And ultimately, the decision is one about how well you sleep at night, in simple terms. If you're a risk taker, you can take a view on it. If you like to sleep soundly at night, knowing that you've got good, provision and room for manoeuvre, then you're in a better place. That's my simple advice, really, around that.
Guy, can I jump in with a couple of thoughts? Just PA,
please.
Just to give a different take on it. I think one of the things I always say to clients when we're looking at acquiring businesses, we'll look at the customer list. We'll look at how many of those customers are actively buying and have bought in the last 3 and 6 months, because that's your kind of active buying client list. We'll also look at the buying cycle, and the other, because ultimately, one of the things I say to clients is all the money you need for every deal you're trying to do is currently sitting in the hands of someone else. They're just called your customers. So the question then becomes, what is the opportunity to cross-sell and upsell in the first 90, 120 days to the client base, other products and services that they may not be aware of, which is what our fastest path to cash, which can generate a significant amount of extra cash flow in the first kind of 3 to 4 months of owning that business, but also looking at what's the continuity income model. So do they have a continuity income model in the business right now? If not, how quickly could we set up and install a continuity-based income model that we could sell and market hard in the first 90 days out the gate. The guarantee that would cover, if we could get that to cover the debt repayments, then life is great and we're in a really strong position. So I just wanted to kind of give a different take on kind of some different ways of looking at funding at it, because the reality is, like, what else can we sell to our existing customers who already have a know, like, and trust the brand, but maybe don't know about all the products and services, or we create that additional continuity income, which, as Jeff will tell you, is one of the 8 value builders anyway. But if you add that continuity income, you've just increased balance sheet value of the business you just bought. So just a couple of ideas to look at it from a different point of view.
Paul, could you maybe just explain what a continuity-based income model is, if that's all right?
Yeah, sure, Alex. Great question. There are actually 9 of them, and obviously I won't go into them all now, Alex, but if you ping me a DM on Instagram, I'll drop you a couple of PDFs about it if that helps. But one of the things I think, so think about it like this: memberships. So if there's a membership that people could sign up for, so they're paying every month. If there's a service and maintenance program they could take out. If there's, I'm trying to think of all 9 off the top of my head. So any kind of subscription. So think of it as a subscription service. So how could you turn customers who have been buying, say if they were buying every 3 or 4 months, and then you went back to them and said, actually, look, you can go on to subscription where you pay quarterly for this, and you go on standing order forever, and you never have to think about reordering it or running out. It's looking at that. So think about subscription when I say continuity, because that's what I'm really meaning. Does that help?
Yeah, no, that's perfect. Thanks very much.
You're welcome.
Anybody else want to add to Alex's question? Thanks, Paul. I thought that was a really good extra bit of insight there.
Yeah, I think that's ladies first. On you go, Liz.
Thanks. And one thing I wanted to raise, Guy, which is a big problem for many of my clients, is raising finance against intangible assets. Mm-hmm. Because, lenders like Aldermore and other people who invest love it when they've got some bricks and mortar. What they find much more difficult to understand is the sort of clicks environment, and how so many businesses today have got technology within them, and the real value lies within the technology, which of course, or the brands or whatever, or the data, none of which is really properly recognised on the balance sheet. So I don't know if anybody here wants to sort of add their insight into that. I know there are some lenders now who have more of an appetite for lending to technology-rich companies, but that's always been an issue. I've sat on panels at the patent office. I've spoken to banks directly, but getting anybody to lend against that kind of an asset is a challenge.
I think probably the main principal reason for that is bankers traditionally, and kind of not unreasonably, I suppose, want to know if it all goes wrong, how do they get their hands on something that they can turn back into cash? And that's why property is always so popular, because it's that sense of, there it is, it sits there, bricks and mortar, it can't move. We can take possession of it, and we can create some liquidity around a physical asset, even if there is a loss in there, which sometimes think property is always seen as this kind of cast iron guarantee, but it's not really. There's plenty of ways in which property can lose value or cost you money. So I think that perhaps the question, you might actually be better placed to explain this, is how do you take an intangible, an idea, a thought, intellectual property, how do you turn that into a document, a contract, something that someone can get their hands on and go, okay, we own that, and that has cash flowing capability. And I guess that's where your IP expertise may well actually, come in handy.
Well, we do get involved in intellectual property valuations. There are a number of ways of doing it. We find that valuations they are a movable feast. And we do reports to investors, in the, not just around the actual valuation, but what are the drivers of the valuation. In other words, how much of a monopoly is this market? How long will it sustain for? Things like that we kind of know because we know the clients and we know their technology. Yeah. But it's still a real challenge to get that kind of lending. And the sad thing is that in the States, there's much more of an appetite for that kind of lending than there is here. And if you look at some of the sort of companies that have done phenomenally well, like Amazon or Facebook or any of these others. They were funded in Silicon Valley. They were funded by people who took a punt on the IP valuations and the technology that was coming out. We just don't do that here, and I think that's a great shame, because what happens is technology companies, really vibrant, fast-growing technology companies, just get swooped up by either Chinese or US investors, and it's a tragedy.
No, I think that's totally valid, Liz. Maybe we need to start some sort of campaign with the British Business Bank and some of the challenger banks. Although I have to say, my experience with challenger banks is they're pretty crap by and large. There's a lot of noise around fintech, but actually not all that good, really. Jeff, you want to come in on that?
No, I was just mirroring. I was doing what Paul said about the clapping, actually. It was the experience is shockingly bad. In what I've seen, it's just ridiculous. The knowledge is so poor, and it's just. I think they sort of take a sort of retired bank managers who can't get a job anywhere else and stick them there because they think they know about banking, and it's just we had a terrible experience. I'm going to name them because I think it's shocking. Tide Bank, great system to open a bank account, brilliant, way quicker than a standard bank. But then when they looked at the SIC code, they went, we've got a problem with a holding company. I went, why? Well, what's the problem? And they went, we don't support that sector. I'm like, what the WTF? What is that? Holding companies is not a sector. It was unbelievable. So my jaw dropped, and I was like, oh my God, if that's the level of knowledge that we've got in a bank, God help us. So that was one of several experiences.
First of all, I love what Elizabeth is saying. Secondly, Elizabeth, please, can you attach some social media to your Clubhouse profile so I can connect with you and others can?
You must do that.
Absolutely. Our own fund, and we should invest in all the IP deals that are coming out, right? Because I think that's a smarter play for us to create our own fund, right? Let's go raise 100 million and I don't know, start a fund. Why not?
Yeah, no, I like the idea of that for sure. Alex, have we adequately answered your question? Are you happy, or something else that we can?
No, just maybe just a question for Dan on where you're buying businesses with commercial assets underlying. If it's the same as a traditional commercial purchase, or if there's a slightly different format to that lending.
Was two types of lending. You can get normal, traditional commercial finance, as you know, and obviously if there's any development finance. But for the business itself, that could be a number of different finance routes. It could be finance on the commercial property. It could be cash flow finance, asset-backed finance on whatever assets are, grouped together and provided security to an asset-backed lender. And if it's a supply business, it could be, basically factoring as well. So there's a lot of different routes. But to be honest, Alex, somebody in the space, Paul. His boss has years' experience in the whole sector, so it's a one-stop shop kind of thing. You can never have enough finance, as always, but there's a different. If you chunk it from commercial property on the left, business on the right, two different types of finance, and you can start there and then figure out what's the net underlying cash flow from the business side of things, and that's where you start, and then just speak to brokers like Paul. But one more thing on the previous question that you were asking about recurring revenue that Paul answered. For me, getting that baked in day one is really, really critical in terms of your co-working space, which for me would be setting up an online payment system where they're recurring, and it's you just set up, integrate Go Cardless with it, so they're getting billed every month, and they have to opt out, so they have to manually go to the site to opt out. And people are lazy. How long have you had Netflix and never thought about it? So building that in day one as a payments gateway and signing them up on Go Cardless is, for me, is the way to go.
Yeah, no, thanks, Dan. You just prompted a thought which we talked about last night, actually, with the changes that have come from the recent budget. More than ever, I think it's important for anyone in business, and particularly in the M&A space, is to make sure that you've got a SaaS pension, a small self-administered scheme pension, which you can invest back into your M&A activity. But as a means to reduce down that forthcoming rise in corporation tax, it's an absolute no-brainer. I don't know if you've got anything to add on that, Jeff.
Yeah, I mean, SaaS are one of the nicest things in my briefcase. What's happened is a lot of people still don't really know about them, and when they do, what I find is people just suddenly get connected in a way they never got massively excited about, getting 2 statements a year from Scottish widows, and suddenly they're, oh no, I can spend this, and actually their hand on the checkbook and their hand running it. It's just, the whole conceptual change is amazing. Obviously, going forward, all this stuff is going to be massively important with the 25% or up to 26.5% on the marginal band corporation tax rate to actually to extract funds effectively. Massively important. Really sort of good thing to do. I mean, one of the best things, they may be looking to sort of close this loophole, is in effect you actually start off as a final salary scheme. So you have a good year, you make whatever good £1 million profits, whatever it is, and then actually you can probably make a £500,000 or £600,000 contribution, which is just and that really good way of boosting up the company. You don't have to obviously shake it out, define benefits of defined contribution, but it's just a really good way of getting that started. One thing you mentioned, I'll just be a little bit. I appreciate it can be really useful for funding acquisition stuff. I'm always very careful with pensions about, they are there for long-term benefit, and if you're, providing for retirement, and although it's fine obviously to spec them into various things and it's money to use, I think really as cautious as possible is good, because ultimately you want to know you're okay when you retire. So I think it's a little bit of both. I appreciate it's a really good way of using funds, but actually it's a good way of also funding retirement. So there's a bit of a mix on that.
Yeah, I think you're right, Jeff. Just to add a little bit to that, a bit of colour, I suppose, is that having talked to lots of SaaS pension trustees, I think perfectly sensibly, and as you say, with the watchword of caution, the largest proportion of their investment pot tends to be invested in property. And if you work with someone like Dan, you will get amazing returns as well. So, seek out great partners to invest with. But on the other hand, there's often smaller percentages of the pot that remain uninvested. And then most people that run a SaaS pension as a trustee, they're not professional investors. The whole point of having a SaaS is that you're then not relying on the market and somebody else that you're paying fees to. But then you've got the challenge of what do I do with this spare 50 grand? And that's where, 50 grand at a time chucked into some share purchases, either as debt or equity, in an owner-managed business, it can be an incredibly great way to improve and boost your internal rate of return on your pension and recirculate and refinance, really. But all these things, it's at the slightly riskier end of the scale, as you point out. So, caution is the watchword, but it is a great way to use the smaller tail end of a pension pot potentially, and that's what we've seen in looking at the SaaS market, really, which is why I raised it.
I think another interesting point is, for all those, when I've spoken to a number of houses over the last year, every customer, and they usually have on average 300 to 600 customers per SaaS house, and they have on average £300,000 per pot. When they actively invest, that money's either sitting there eroding with inflation, which is an absolute tragic situation, or somebody's active and they can't get rid of the last 50k. So for me, going forward, we're looking into various fund structures to set up that are tax transparent, which basically means the SaaS lends money, gets the money back at gross without deduction of tax. And that's great if you've got money. But imagine if you've got corporation tax and you don't have cash in the bank, because you've got that pain in the arse situation where your cash flows overrun your trading kind of thing. Now, what can you do there? It'd be an interesting situation, but one we've done before, from Elizabeth's camp, where perhaps you've got IP that you can capitalise and then do an in-specie transfer into your SaaS, potentially. That for me is an interesting thing. It's worked before. I've only done it once, and it wasn't into SaaS, but it was to reduce tax, which is a key thing. And it'd be good to get Elizabeth's take on that, because Alex Impey has some interesting IP that he could capitalise up. Think of it like this. It sounds complicated, but it's not. Stelios went public in EasyJet. He then got thrown out, but he owned the license to EasyJet. So every bum that sits on an EasyJet seat, he gets £1. So that's the concept. But there's another side to the concept where you're creating tax relief by doing an in-specie transfer, potentially, subject to trustees being on board, into the SAS that creates a reduction in corporation tax in the company. What's your thoughts on that, Elizabeth?
Well, we've done those kind of deals in the past. We did one, it's a long time ago now, with a brewery, believe it or not. But one of the problem that we have, whoever we are dealing with, is an understanding of intangible assets. And that's always the stumbling block. So, for example, when we did the lending against the brand portfolio of this brewery, they didn't have any registered trademarks, which was a sort of like a red flag to me. It was like, alarm, we've got to get these registered, we've got to look after this. And we said that, but actually the pension fund weren't interested in making that investment because the problem is people see intellectual property as a cost and not as an investment. And in fact, it's treated on the balance sheet as something that's a sort of a cost rather than something that's going to accrue in value. So a bit like buying a van, you'll spend £3,000 on your van, and the cost of that is sort of amortised over 3 years or whatever. But if you invest £3,000 in a trademark, after 3 years, you've got a really valuable brand that's keeping people coming back into the business. And fundamentally, that's the stumbling block with intangible assets, and they're just not recognised. They're not recognised on the balance sheet very often. The only way I think you can do that is to sort of transfer them out to a holding company. Don't ask me, that's not my specialist area, but that's the kind of thing that we've done. So we come back all the time to actually understanding what intangible assets are and how they add value.
Yeah, how we quickly did it before, just 2 seconds, is we produced a manual and put all the systems, procedures, processes within that manual, brand logos and the whole 9 yards, and produced a whole document that basically described in detail, what the IP is and what the charge would be back to the company that had use of the IP and the term of that use of the IP, and on what conditionality the company that owned it could actually break the license agreement. So it was quite detailed, a real thorough document. But it'd be great to get Jeff's take on that as well from a tax point, in terms of wrapping up IP into into a kind of capital, contributing it, and then renting it back, kind of thing. What's your viewpoint on that? Whether it's a SaaS or a company, Jeff?
I think it's really important because when you look at any trading company is always subject to a degree of risk that is always there. So when you've got assets of real value and obviously intellectual property and something that produces sort of regular income, if you're leaving that in a trading company, then you're making potentially exposure. If that company falls over, you're going to lose that intellectual property. So structuring wise, I'm a big fan of moving that into either a top holding company or maybe an intermediate holding company. The reason I'm saying either or, it's depending what our final exit is. We might sell that bit of the business, not the rest of the business. So we need to know what the full plan is. But it's a really good way of de-risking, and bizarrely, it's a really interesting way of creating balance sheet value by revaluing the tangible asset within the subsidiary company. So it costs you a quid and it's worth, make up a number, 500 grand. So your first stage is you bring that onto the balance sheet in the subsidiary company, so £500,000 asset, £500,000 revaluation reserve. You then move it into company up the ladder, so to speak, sell it up, and actually you bizarrely convert your revaluation reserve into a profit and loss account reserve. So without actually paying any tax, we've created £500,000 worth of distributable reserves, which as I say, gives me a little bit of a smile. It's one of those, when we first came across that, we thought, this is too good to be true. But actually, I contacted the Institute of Chartered Accountants just to go through, and they said, yeah, no, that's fine, that works. So I quite like doing that. So in an effective way, it's a way of properly increasing the value of your balance sheet in a profit and loss account way without actually costing any tax. So that's a really useful thing to do. I've not done this disposal to a pension fund. My always worry about pension fund disposals is because of the £1 million limit per person. If you're setting something up that could really be of massive value, it's so easy to overfund it. So obviously with pensions, just being a little bit careful about it.
Yeah, I think they're great points. Two other things as well that's really beneficial when you do this kind of thing is your ring fencing assets. You know, and your IP is an asset, ring fenced in your holding company, as Jeff just described. But the biggest thing for me is you're setting yourself up to sell. You know, and as part of the selling solution, if the buyer coming in can't, quite put the down payment down, you don't have to sell them your IP. You can rent it to them. So you're setting yourself up to be a friendly seller when the time comes to vendors that don't quite have the full equity, and you can be part of that equity going forward because you're contributing the equity via renting the IP and then give them an option down the road.
Yeah, I love all those ideas. They're great, and we've been involved in that in the past. The big problem is that, generally speaking, people aren't aware of how to do that or why to do it or how it all works. And, they're not aware of sort of some basics, really, which is that, charges are securable at the Intellectual Property Office. So you can, secure a mortgage against a patent or lending against a patent actually at the IPO. The same with trademarks and registered designs. But because these are poorly understood rights, people just don't get it.
Liz, I feel a really important FAQ leaflet coming on here. Between us all on this panel, we need to get our heads together and produce something that will be of real benefit to business owners and people interested in the arena. But I'm conscious I want to kind of keep the conversation flowing onto perhaps some fresh topics. And we've still got 3 people who have come and joined us on stage. So Elaine, welcome. The better half, I believe.
Well, thanks, Guy. Thanks for having me up. I don't know how I'm going to follow that. I've only got 3 little questions here. So, yeah, I'm Dan's wife. We've been together since I was 18 and he was 21. So we've had definitely the roller coaster ride of buying businesses and commercial for over 30 years. So my question to you, really, Guy, is in this environment that we're in just now, what sectors do you favour when you're buying businesses and why? Mm-hmm. And I'll just put in the other 2 while I'm here. And what on average would your debt cover be? And most importantly, how low would that go before you would walk away from the deal?
Brilliant question. So the first answer is what I always call bog roll companies. So we all as human beings use toilet paper every day. It's an essential of life. So I try to find companies that essentially provide those core services or products that everybody needs, and I prefer business to business. It's easier to fund rather than B2C. And if you think about, particularly in this last year, the impact on consumer-facing companies, and many of those have been massively stressed by what's gone on. And it's much harder to predict revenue streams in general in B2C businesses. So I focus on B2B. And I focus on products and services that either have long-term contracts, so we operate in the scaffolding industry and we have contracts that take 2 years in some cases to work through. So we've got a reliable, predictable income stream with known profit margins. And then we also look at things like, we're just in the throes of Touchwood, acquiring a civil engineering business, working with Phil on a manufacturing engineering business. So these are all kind of companies that produce boring standard services and products that people need all the time. So that's my kind of always my starter for 10. Try to think of companies that do that kind of thing. Simple business models, don't need complex processes, don't need highly paid, highly intelligent people like lawyers. Just guys that can lift heavy things and do good things. So that's my kind of starter really. And in terms of debt coverage, as I touched on before, I like to think about how much cash is going to be left in the bank at the end of every month versus what my costs might be and what's my gap, and essentially a ratio of kind of 1.2 to 1.4 of debt service. So for every pound I've borrowed, I've got 1.4 coming in, essentially. Does that answer the question, Elaine?
Yeah, that's great. Thanks, Guy.
Yeah, perfect. Great stuff. Sebastian, welcome to the platform.
Yeah, thank you very much. You just touched on improving cash flow on day one, as well as within the next 90 to 120 days after you acquire the company. So I would like to have a little bit more deep dive on that, because I'm about to acquire my first one now, and putting the plan together. And I have quite a few opportunities, but it's always like, what is the best and easiest way to get me to my goal in the first place? And all the other stuff I still can do a little bit further down the line, so I want to set priorities and stuff.
Okay.
So if we could touch on that, would be great.
Yeah. So what sector are you looking at acquiring in?
It's a simple business. It's ink cartridges, so don't get me wrong, but personally I'm not interested in any single ink cartridge. But it's quite a highly profitable business, so the margin is quite huge. And it's a great boomer, he wants to get out, so which is fine. So we are negotiating and doing stuff, and as well as they have like various different places in UK, as well as in Dublin where they're based. They have a production line, but they don't have commercial properties. And there's also like one of the exits I'm coming from, because they don't have them, and their leases, they're already expired since years, I guess. So I literally can either go and buy the property or relocate them into a property I like. So.
Cool. Okay. I think does the company come with any kind of management team, or are you going to have to run it, or are you going to have to develop a team around you? What are you stepping into?
Yeah, no, I'm absolutely not interested in running a company. I don't want to have a job. Secondly, the owner himself, he's from UK, but he went to Florida and is enjoying his life there. So he put like 2 management people in place, and I want to have them in the company as well as shareholders at some point, like 2-3 years down the line. That they are really responsible for what they are doing, and that they have that they know what they are getting up for in the morning.
I think that's an interesting point. I just want to pull Kim in at this point, because this may be something that you've got experience of, Kim, in terms of the legal documentation, the framework that maybe creates opportunity for those junior managers, things like share options or golden handcuffs and so on, because I think what Sebastian's talked about is really important in trying to make sure you've got really strong structures so that what you acquire, people don't just walk out, because then you've got yourself a whole load of hassle, really. Anything you want to add on that?
Yeah, I think you've said the main one, which is, can you hear me okay?
Yes.
Yes. Which is offering incentives. So performance-based incentives work really well. Share options also work well if you can do that. In my experience, share options are always the best, because they're incentivized. They're incentivized to grow the company with you. You almost become partners instead of the sort of employee-employer relationship. But also bonuses work really well too.
Okay. And just for the benefit of those that are perhaps less familiar, share options are essentially a legal right or an opportunity for an individual to be gifted or acquire shares either at a pre-agreed price or a certain framework. And